Liability. It's a word I'm sure you've used many times before, possibly without knowing exactly what it means. But even though you may not know the exact definition, I'll bet you have a basic understanding of what a liability is. If you say that a liability is something you owe, or something that takes money out of your pocket, you'd be on the right track. But there's more to it than that, so let's take a closer look at what exactly liabilities are so that you can know for sure what to include as liabilities on your balance sheet. Buying a house can be very expensive, so it's common practice to borrow money from a bank to help fund the purchase. This loan is typically called a mortgage, and it must be repaid over time, usually with interest. So this raises a question. If the house is considered to be an asset, does that make the loan a liability? Well, put simply, yes it is. You see, one of the things liabilities are used for is to buy assets. So if the house fits the definition of an asset, any money borrowed to help buy the house would be regarded as a liability. If you lived in the house and it was regarded as a personal asset, any loans used to buy the house would be regarded as personal liabilities. If you went to the bank and they asked you to list your personal assets and liabilities, you would include the house on the list of assets and the loans used to buy the house on the list of liabilities. If you rented out the house, which would make it a business asset, any loans used to buy the house would be regarded as business liabilities. So, if you put together a balance sheet for your business, you'd include the house as an asset and the loans as liabilities. And the same goes for any money you borrow to buy other types of assets. This concept does not just apply to houses. In a nutshell, if you fund the purchase of an asset with a loan, then the loan will be regarded as a liability. Okay, so that covers money borrowed to buy assets. What about money borrowed to pay for expenses? Let's say you're a bit short of cash, so you use your credit card to pay some bills. By doing this, you have effectively borrowed money that needs to be repaid, usually with interest on top. So, are the borrowed funds a liability even though the money wasn't used to buy an asset? Well, once again, yes it is. If you paid for some personal bills with your credit card, you would need to include the outstanding balance of your credit card on your list of personal liabilities if you went to the bank and they asked you to list your assets and liabilities. In this case, however, because you used the funds to pay some bills, you won't have anything to add to the list of assets, like you did when you borrowed money to buy a house. Similarly, if you use your business credit card to pay some business bills, you'll need to include the outstanding balance of the credit card as a liability when putting together a balance sheet for your business. And once again, you won't have any assets to include on your balance sheet because you used the funds to pay some bills rather than to buy assets. Okay, as you can see from all these examples, liabilities can be created by borrowing money to buy assets or to pay for expenses. So let's finish off by taking a look at the rules for working out whether something is a liability from both a personal and business point of view. In your personal life, something can be regarded as a liability if it satisfies two criteria. It's something you owe, and it has a measurable value. In the business world, there's a third criteria, and that is that the thing in question must be expected to take money out of your pocket, usually through some sort of expense payment or financial loss. So, for something to be considered a liability in business, it must satisfy the following three criteria. It must be owed by the business, it must have a measurable value, and it must be expected to take money out of your pocket. And that fits with the accounting definition of a liability, which is something a business owes that has a measurable value and is expected to result in the future sacrifice of an economic benefit. So there you have it. Those are the rules for determining whether something is a liability from a personal point of view or in the business world. I hope you now have a clear understanding of the difference between personal liabilities and business liabilities so you can work out which ones to include on your business and personal balance sheets.